So after demonetization in 2016, a lot of people became interested in stock market investment, and so they started investing in equity through various means. But still, there are many people who are not convinced to invest directly in the stock market. They want a safer way to invest their money and earn good returns. So what do? They invest in mutual funds. Today we will discuss both these options, and we'll try to answer which one is better for you. So let's first start with understanding the basics of both the options. In simple words, stock market is a place where you can buy shares of an individual company. When you buy a share of a company, you become a part owner of that business, and so you can also enjoy the benefits and take the risk of that business. On the other hand, mutual funds are professionally managed investment portfolios that pool money from multiple investors to invest in a wide range of financial assets, such as stocks, bonds, money market instruments, and so on. When you invest in a mutual fund, you don't own any physical asset like a stock or a bond. Instead, you own a unit of the mutual fund. And when you buy or sell a unit of the fund, you actually buy or sell your share of the holdings of that fund. Now let's understand the difference between these two investment options. 1. Risk and return. Let's talk about the risk and return of both the options. Stock market investments are considered to be riskier than mutual fund investments because when you invest in the stock market, you are putting your money in a single company, and so the ups and downs of a company directly impact your investment. On the other hand, mutual funds spread the risk by investing in a variety of securities. So even if one security underperforms or goes bankrupt, it won't have a major impact on the overall portfolio. Now let's talk about returns. Generally, stock market investments have higher potential returns compared to mutual funds because you are taking more risk. The reason why mutual funds have lower returns is because they invest in a diversified portfolio, and they do hold very sophisticated strategies. The return of a mutual fund is determined by deducting the fund's operating expenses, including the management fee, from its total return. That's why mutual funds are called as the risk-adjusted return investments. Simply put, if you want to maximize your returns, then you should go for individual stock investments. But remember, you must have good research and analytical skills. 2. Who should invest in stock market and who should invest in mutual funds? If you want to save tax, then equity is the best option because you get a tax benefit of up to Rs 1 lakh under Section 80C of the Income Tax Act. The only condition is that you cannot redeem your investment within 3 years from the end of the financial year in which you invest. Now coming to the second question, who should invest in the stock market? Well, according to me, individual stock investments are best suited for experienced investors who have done extensive research on a company and have a clear understanding of its future prospects. This means that you should have knowledge about the company's products and services, management team, competitive advantage, and financial health. Moreover, you should be able to assess the company's future growth potential and how it is going to perform in the long run. Another important aspect to consider is your ability to take risk. Investing in individual stocks can be risky, and you may lose some or all of your investment. Therefore, you should only invest money that you can afford to lose and be prepared for potential fluctuations in the value of your investment. Additionally, you should have the time and patience to track your investments and make informed decisions about when to buy and sell. Overall, investing in the stock market can be a great way to build wealth over the long term. However, it's important to be aware of the risks involved and to invest responsibly. On the other hand, mutual funds are generally considered to be a good option for investors who are not comfortable with the level of risk associated with individual stock investments or do not have the time or expertise to manage their own portfolios. Mutual funds offer diversification, professional management, and a convenient way to invest in a variety of securities without having to spend a lot of time researching individual stocks. 3. Time and effort required. As discussed earlier, individual stock investments require more time and effort compared to mutual funds. You need to stay updated with all the latest news and analysis related to your company, and you need to track its performance on a regular basis. This means that you should be able to dedicate a significant amount of time to managing your investments, which may not be feasible for everyone. Now let's talk about mutual funds. You don't have to spend much time managing your investments. You just need to select a fund that aligns with your investment goals and risk tolerance, and then sit back and let the fund manager do the rest. Of course, it is still important to do your research and choose a reputable fund manager with a proven track record. But once you've done that, you can be confident that your money is in good hands. Number 4. Cost and fees. Let's compare the costs associated with both the investment options. We'll talk about stock market investments first. When you buy and sell shares of a company, you have to pay a brokerage fee to your broker. Apart from this, you have to pay taxes on your capital gains. But the good news is that you don't have to pay any fund management fees. These costs are usually very low, especially if you trade online. Now let's talk about mutual funds. Most mutual funds charge an expense ratio, which is a fee that covers the cost of operating the fund, including the fund manager's salary. The expense ratio is usually a small percentage of your investment, typically ranging from 0.5 to 2%. Apart from this, some mutual funds may also charge an exit load, which is a fee that is deducted from your investment when you sell your units. However, not all funds charge an exit load, and many funds that do charge an exit load will waive it if you hold the fund for a certain period of time. Overall, the costs associated with mutual funds are relatively high compared to stock market investments. Number 5. Liquidity and accessibility. In simple words, liquidity refers to how easily you can convert an investment into cash without significantly impacting its value. Let's talk about stock market investments. Generally, stocks are considered to be quite liquid, meaning that they can be bought and sold quickly and easily. If you invest in stocks, you can sell your shares at any time during the market hours. Just keep in mind that the value of your investment may fluctuate depending on market conditions. Now let's talk about mutual funds. Some mutual funds have a lock-in period, which means that you have to keep your money invested in the fund for a certain period of time before you can withdraw it. For example, ELSS funds have a lock-in period of 3 years. However, many mutual funds are liquid, meaning that you can withdraw your money at any time without any penalty. Before investing in a mutual fund, it is important to check whether the fund is liquid or not, and if there is a lock-in period, then find out how long it is. In conclusion, both stock market investments and mutual funds can be valuable investment options depending on your individual circumstances and financial goals. Stock market investments can potentially generate higher returns, but they also come with more risk and require more time and effort to manage. On the other hand, mutual funds offer diversification, professional management, and liquidity, but they also have higher costs and generally lower potential returns. It's important to carefully consider your investment goals, risk tolerance, and time horizon before deciding whether to invest in the stock market or mutual funds. If you are an experienced investor with a high risk tolerance and a long time horizon, then you may want to consider investing in individual stocks. On the other hand, if you are a beginner investor or do not have the time or expertise to manage your own portfolio, then you may want to consider investing in mutual funds. Ultimately, the best investment option for you will depend on your individual circumstances and financial goals. If you liked the video, then do subscribe, and thanks for watching.